Hey, this is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. It is Thursday, August 20th, and you are tuned in to Next Level Charting. Thank you very much for joining us. So today we're going to dive into the equal weight sectors. We're going to rank them, we're going to chart them, and then we're going to look at some bearish charts in some stocks related to finance and energy. So we're going to start off by looking at the weightings within the S&P 500 equal weight SPDR. And this is an important benchmark because whereas the S&P 500 SPDR SPY weights its components according to market cap, which means the big four account for over 20% of the ETF. Technology is like 27% of the ETF. The S&P 500 equal weight ETF has a completely different profile when you look at the sector weighting. So I am on etfdb.com to look at the weightings, and you can see a link over there on the left for holdings. And I'm going to scroll down over here and look at the sector breakdown. And so we can see on this sector breakdown here that the top three sectors, actually the top sector is industrials. So industrials, technology, and healthcare are coming in around the same. Consumer cyclicals, which is the same as consumer discretionary, and financials. So those five sectors are weighing between 12 and 14%, roughly equal weighted. So this is a more broader benchmark, if you will, that's weighting these sectors equally and give you an idea of how the average stock, the average sector is performing in the market. And look at communications is down at 4%. It's the smallest sector. I have no idea what other is. I can't believe it's 5%, but anyhow, that's another issue. But communications is a big sector in the S&P 500 SPDR because it's got Google and Facebook. But here, when you equal weight it, it becomes the smallest sector. So now let's look at how these sectors are performing relative to each other. All right, so now I want to look at the percentage of stocks above the 50-day EMA for each of the sectors. Now, these are calculated using the sector SPDRs, but when you look at breadth indicators, they are equally weighted because it's +1 when you're above the 50-day EMA, and it's -1 when you're below the 50-day EMA, regardless of market cap. So that's why it's called a breadth indicator. It's a broad measure that treats all stocks equally. And so this is a medium-term indicator, if you will. It's probably more in the realm of mean reversion than longer-term trend. Actually, mean reversion is probably 20 days or so. But looking at this percentage above the 50-day EMA, we can see how many stocks are, say, in short to medium-term uptrends if they're above the 50-day EMA. And you just click that top column here, the close, to sort by that. And we can see that consumer staples are at the top, consumer discretionary is at the top. It's weird to see both of those at the top because they should be diametrically opposed, but that's the way it is. Industrials are at the top, 87%, communication services. And then we look down and we can see, look at technology, down at 66%. It's one of the weaker sectors, medium term. Utilities, energy, and REITs are also not showing very much strength. In fact, energy is below 50%, as are REITs, real estate. And now for a longer term perspective, we're going to look at the percentage of stocks above the 200-day EMA. These are stocks that are in long-term uptrends, and we can see a change already. Consumer staples was number 2 as far as the medium-term uptrends, with 90% or so of stocks above the 50-day EMA. And it's number 2 for percentage above the 200-day EMA. So this is a sector with lots of internal strength, staples. Healthcare, 85% above the 200-day EMA. That's another strong sector, and I put industrials as strong too. So technology's dropped a little bit, but look at the weak sectors. Okay, consumer discretionary long-term is not that strong, 65%, but it's still net bullish, all right? And if you look at the weakest sectors, look at finance, 36% above the 200-day EMA, and energy, 11.5%, and real estate. So these three sectors you definitely want to avoid. Utilities sitting on the fence, 50%. What are you going to do? And then we can see the S&P 500 is the strongest of the three indexes. Mid caps are a little weaker, and then small caps are right at 50%. So they're on the fence as well. But we can clearly see healthcare, staples, industrials leading in this, and then finance, REITs, and energy lagging. So now let's look at the individual charts. So I've got a chart list here, and I've got the S&P 500 equal weight SPDR at the top, and then I've got it arranged according to the sector weight. So the biggest sectors at the top, the first chart you'll see after this, industrials, and as you can see there are the weights there. So we'll see industrials, technology, healthcare, and so on until we get to communications. The first thing I want to point out is we know that SPY is hitting a new high. So it is above this February high. But you can see that the equal weight S&P 500 is nowhere near its February high. And you can also see that it hasn't even cleared the June high. And these are what I call benchmark highs. So if you've got a stock or an ETF that's above the June high and above the February high, it's a leader. But if you've got a stock or an ETF that is not even above the June high and not even close to its February high, it is clearly a laggard. And so this is this discrepancy that we're seeing in the market. We've got the SPY hitting new highs and leading, no problems there, strength. We've got healthcare leading the SPY higher. Healthcare is one of the bigger sectors. But when we look at the equal weight version, we can see it's not as strong. It's above the 200-day, and the PPO 20-200-0 is positive. So that means the 20-day EMA is above the 200-day EMA. So the cup is half full, and you could mark your support there at the June low. That's the benchmark low. And when we start to see, or if we start to see, a number of stocks and ETFs break that June low, then we have trouble. But right now, as long as we're holding the 200-day right there and the June low, the bulls have the benefit of the doubt here. So when we look at the sectors, we can compare these benchmark highs. So here's industrials. It's cleared the June high. Okay, that's +1, but it has yet to clear the February high. So it hasn't confirmed the new high in the S&P 500, and the S&P 500 equal weight has not confirmed either. But industrials, okay, they're kind of in the middle. Cup is definitely half full because you're well above that June low and above that 200-day there. Then we look at technology. And so, it has not cleared that June high, that February high. It is right at that February high. It did clear the June high. So this one is strong. And there's that June low matching up with the 200-day. So yeah, maybe it could pull back, but it's still in an uptrend. Technology looks good. Then we look at healthcare, and it is the strongest sector. There's that February high. It cleared the February high in June. And there's the June high. It cleared that June high in July. So it's kind of consolidating here, but it is by far the strongest sector we've seen of these three so far. Then we look at the equal weight consumer discretionary ETF, and it looks nothing like XLY, which is hitting new highs. There's the February high, not even close. There's the June high, just equaled it. So not much confirmation there, but we're holding above the June low, so the trend is still up. But clearly, there's more weakness within the broader consumer discretionary sector when we look at RCD. Then if we look at finance, this is one of the weakest sectors out there. There's the February high, not even close. Didn't even get close to the June high, and we're below the falling 200-day. So I think that this one is still in a long-term downtrend and vulnerable to further weakness because you have this decline, this bounce, and if you break down there, that's going to signal a continuation lower. So I would be staying away from finance. And that's an important sector. The fact that finance isn't performing well tells you that this market is not clicking on all cylinders. Here's consumer staples. It's doing okay. It hasn't cleared the June high, February high, but it did clear the June high. So it's doing all right. And then we can see real estate. It's the other weak sector, and we saw that with the percentage above the 200-day. So we want to avoid stocks in finance, stocks in real estate. As you can see, didn't even clear the June high and below the falling 200-day. So I would be avoiding that sector. Then we look at materials. It's doing okay. It's near the June high, near the February high, and it has cleared the June high. And then we look at utilities. Utilities are underperforming. All right, there's that February high, not even close. There's that June high, and we're falling at the 200, failing at the 200-day moving average. So utilities are seriously lagging. And then we look at energy. Energy is another laggard, not even close to the February high, not even close to the June high. Actually, that's a January high, and looks like it's poised to break down and move lower. And then communication services, the smallest sector, but it is a leader because it is back near that February high and above the June high. So what's happening on trendinvestorpro.com? Well, on Wednesday, I put out my ETF ranking and grouping and analysis report with lots of charts. That includes a chart book with 60 ETFs that are annotated with comments. And I also include a PDF that has a scatter plot. And I'm showing the uptrends here with the Stoke close indicator. And there you can see these ones at the top are in uptrends, and these ones at the bottom are in downtrends. And then I've got RSI down below here. And so if you're on the left-hand side, you're in an upper left-hand side, you're in an uptrend, and you're a little bit oversold. And that's kind of the area of interest. And we want to avoid the ones that are in downtrends. And then I have a ranking table where I rank my 60 core ETFs according to the Stoke close. And then I show if RSI is oversold. So that's just part of the report. I had a Q&A as well this week where I talked about using chandelier exits and showed you some back tests for timing the broader market. And then every week I put out a video covering all the ETFs as well as the broad market timing report. So take a visit to trendinvestorpro.com if you're interested in more. So looking at some stocks in the finance sector, and then we'll look at energy, these stocks just don't look good. These are not good-looking charts at all. This is Citigroup, and it looks like it has had a counter-trend advance. It has failed at the 200-day, and it is on the verge of breaking down and continuing lower. There you can see there's that June high for JP Morgan. Didn't even challenge it, didn't even get above the 200-day, so it's clearly weak. Same with Bank of America, failing at the 200-day twice, and Wells Fargo is even weaker. It looks like a bearish pennant here forming, and a break would signal a continuation lower. So when we look at some key energy names, we can see similar patterns. There's the June high and the 200-day for Chevron. Below both, didn't challenge. ExxonMobil's even weaker, didn't get near the June high or the 200-day. Halliburton got above it, but still, I would be very careful with this one because of the sector. And then Baker Hughes failing below the 200-day and below that June high. So these ones are looking vulnerable. So that concludes this edition of Next Level Charting. Please visit trendinvestorpro.com if you'd like to learn more about my services. Thanks very much for tuning in, and have a great day.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.